Ever wondered what is a balance sheet and how can I read a balance sheet to learn more about the financial situation of a company? What do the various financial terms on the balance sheet mean and how do I understand the full picture? The balance sheet is an overview of what a company owns and what a company owes at a particular point in time. What is owned is on the left, what is owed is on the right. The balance sheet is one of three very useful financial statements that a company puts together and publishes. The other two financial statements are the income statement, an overview of the profit or income that the company generates during a period, and the cash flow statement, an overview of how much cash the company generates and where it spends that cash during a period. The balance sheet is a statement of the financial position at a point in time, so it's like a picture. The income statement and cash flow statement both cover the flow during a certain period, usually a month, a quarter, or a year, so they are like a movie, each with its own focus. When reading a balance sheet, it is important to start off by looking at the balance sheet by category. Current assets and non-current assets on the left, current liabilities, non-current liabilities, and equity on the right. Current assets are cash and other assets that are expected to be converted to cash within a year. Non-current assets are longer-term investments that cannot be converted into cash quickly. Current liabilities are amounts due to be paid to creditors within 12 months. Non-current liabilities are amounts owed that are to be paid after the period of 1 year. Equity on the balance sheet is the book value of the shareholder capital. That's the conceptual framework of the balance sheet. Now let's examine the real-world example of Invent, the ERP and ICT Solutions Company. Invent's fiscal year runs from February to January and we'll be reviewing the year-end balance sheet dated January 31, 2024. Current assets, $75.1 million. Non-current assets, $185.2 million. Total assets, $260.3 million. Current liabilities, $70.8 million. Non-current liabilities, $99.1 million. Equity, $90.4 million. As the term balance sheet implies, the total amount owned, assets, equals the total amount owed, liabilities plus equity, adhering to the accounting equation. Assets equals liabilities plus equity. Let's dive deeper into the balance sheet and examine each of its key categories. Current assets, non-current assets, current liabilities, non-current liabilities, and equity. While the structure remains the same, there's much more detail to explore within each category. In the American format of the balance sheet, assets are organized from most liquid, easiest to convert to cash, to least liquid, while liabilities are listed in order of payment priority, from due first to due last. Let's recap the main line items in each category for a better understanding. The balance sheet provides an overview of what a company owns, assets, and what it owes, liabilities, and equity, at a specific point in time, offering valuable insights into its financial health. It can reveal fascinating stories about a company's financial position and operations. If you have any questions about the balance sheet, feel free to post them in the comments below this clip. At Invent, we try to make accounting, finance, and business management fun and easy to understand. With continuous learning, you will master the business and accounting terminologies. Follow us for more knowledge.